Welcome back and many thanks for staying with us. My name is Rama Busiku. We are getting into another very pertinent conversation about the performance of the Uganda Retirement Benefits Regulatory Authority in the year 2020. The performance of the pensions sector. We would like to know. You remember during the onset of the COVID-19 pandemic, there were calls for midterm access to the savings of many of the savers that are being kept with NSSF. But then that did not culminate into anything because the argument was that most of the savers with NSSF have less than 10 million in those coffers. So 10 million, if you're going to use the 20%, you would go away with little money and it wouldn't go very far enough to help you alleviate some of the challenges that were plaguing so many people during the COVID-19 pandemic. We also noticed that most of the savers decided to keep their money with NSSF. Most of the people who had hit retirement age and were able to get their money to withdraw it from NSSF refused and decided to keep it within the coffers of NSSF. And we've also gotten information that interest rates have accrued in that regard. But then we'd like to understand what has been the performance of the pension sector. I do have Mr. Martin Nsubuga, the Chief Executive Officer for the Uganda Retirement Benefits and Regulatory Authority. He joins me right now in studio. Well, Mr. Martin, very good morning.
Good morning to you.
Your performance for the year 2020 highlights a growth of 16.8%. That's a little bit like a 17% growth. Yeah. How were you able to pull that off given the onset of the COVID-19 pandemic?
Well, first and foremost, thank you so much for hosting me this morning. It's a pleasure, and I know I don't take it for granted.
Indeed.
Well, I would say that before COVID, or that's early March, we had already registered some growth. However, when the lockdown started, we could not envisage what would happen into the market, and we could not fully understand or project what would happen. So we thought that around this time, would provide a feedback to the audience that irrespective of the COVID times, your funds are safe, well invested and protected. By and large, we would say that what has driven this growth is basically prudence in investment. We have professionals who are doing their work very well. That's the fund managers, and of course, we the regulators have done our work very well to supervise the sector, oversee, and also to ensure that everything is in order. Besides, we put in more effort to enhance the competencies of trustees who have done also their work very well. So by and large, those three factors are failed. But notwithstanding, the concentration of asset classes in this market is in government securities by and large, and people and the schemes invest long term. So if they invested 5 years beyond, 3 years beyond at modest rates of between 12 and 13%, you would expect good returns, and that provides the growth and the returns. But besides, the 16.8% you mentioned about, it is actually lower than what we had anticipated. You may realize that our market or sector is growing at an average of close to 20% for the last 5 years. Last year it was 18%. So 16.8%, yes, it's good growth, but it is lower than our anticipation. And by and large, you would say that, yes, there is, of course, the investments I've talked about. But why we are having that lower growth is two factors. One, reduction in contributions because
people are not working.
Exactly, people are not working. Some entities are closed shore, and of course there are some constraints in employers making contribution. The other one, there are some cash flows, the cash streams that the schemes get as income. You may realize that all financial institutions in this market that are listed on the stock exchange did not distribute dividends, and that was the directive of the central bank. It was good for capitalization of banks in this market, but it was a disadvantage to the schemes, which by and large have invested largely in these financial sector instruments. We have around 51% of our equities invested in financial institutions in this market. So not declaring dividends affected the cash flows. Of course, the second, as I mentioned about, some employers failed to make contributions. Not so many, but some are now. Of course, we gave them three options. One, you can defer making contributions. There was some kind of a deferment of contribution.
From April to June.
Yes. Now we see a recovery of that, but there are some schemes which have some unique characteristics in their trust deeds where an eventuality of this kind, they are allowed to terminate contributions. Of course, the trade-off is that they are not closing, they are not cutting off jobs, but rather keeping the jobs for them. Once the situation normalizes, they will come back and then they can make further contributions. We had such situations. But there are some few characteristics. We lost a scheme because of the economic environment, and that affects the portfolio and the flows. That summarizes what happened in this market.
Indeed. Of course, amidst all the challenges, we also saw savers get a 10% interest on their savings. How did that come about in the wake of COVID-19?
Yeah, that was, on average, that's what NSSF declared. But on average, most schemes declared something 10 plus returns. Of course, like I've said, the biggest concentration of assets in government securities. And like I've said, the returns or the yields are between 12 and 13%. Now, we've made effort to ensure that there is no extravagance in using members' funds, wastage. So we made effort in reducing expenses. At the moment, expenses as a percentage of asset, it's around 1.3% on average. So if you're making 12%, 13%, and you reduce it by 1.3%, you are expected to declare interest of 10 plus. So if you have something less than 10, then to us that is a question, because we know you are investing your assets. They're in government securities. Of course, we had equities which didn't do well, like I've said, the financial sector which didn't declare dividends. But the Kenyan equities market, where we have a high concentration, did not perform very well. It was a downward trend. Fortunately, it has recovered in the last quarter, and we anticipate that the future is very bright. And of course, Safaricom, which is a major as far as the equities is concerned, is not really doing very bad because of, I think, the usage of data, etc. So, by and large, yes, we wouldn't come and explain that the investments have done very badly, because we know where the money is. We monitor it and we follow it up.
And we also do understand that the issue of midterm access to the savers' money was also halted in the midst of a very, very, very huge heated debate.
Yes,
you know, you had people who are saying, no, for me, I'm going to keep my money there. I cannot withdraw it during the pandemic so that it can accrue some kind of interest. But then you had some people who are saying we should be allowed to get some 20%. But then some people were saying, how can you be very, very sure that you'll be able to use that money for something tangible? 20% of 10 million can't culminate into something positive. And you yourself, you are also against it. Give us your reasons and why it didn't pull off.
Well, first, the reasons we gave were basic reasons. The first one is it's not provided for in the law, because the framers of the law never envisaged that around this time there would be a situation like this, or in the event of any catastrophe of some kind, people can access this money. The intention was very clear. These monies are supposed to be saved for retirement. Secondly, the amount you are contributing is not big. You are contributing only 5%, so you are remaining with 95%. If you have any other occupational scheme as a supplement, maybe you are contributing another 5%. So where do you put the 90%? So it is kind of a culture thing which we need to change.
It goes back to saving culture.
Exactly. The third one is, you know, like you've said, when you start drawing down this money, 20%, you're ideally losing out the opportunity of accumulating those funds. Ideally, the benefit of saving for retirement, you save small, like you had 5%. However, you need to keep it there to grow. Okay? Save it 5%, be consistent. That's why it is monthly. Those who do weekly under the voluntary arrangement or any other, small, be consistent, leave it to grow. Now, when you distort the leave it to grow, it appears that you are distorting the anticipated accumulation. Now, if you take the 20% example you've given, and you are 25 years, 35 years, the retirement age is 55 years as far as NSSF is concerned, or 60 elsewhere. So it means that you are losing an accumulation phase of over over 30 years.
So if I'm allowed midterm access to my 50 million, yes, and I want only like 10 million,
Yeah.
how much would I be remaining with by the time I hit 55?
Well, there's some mathematics you need
I
to
was
do.
looking at the numbers and it was like only 26 million, no interest at all. You remove 10 million,
Yes.
you're going to accrue an interest of 16 million from the 10 million, that is already 26. So you're remaining with only like less than 26
Yes,
million
but
at the end of the day.
there you would have assumed probably an interest
Discounted
rate
interest or something.
that is not compounded. Here we are looking at reinvesting even the interest you're earning. You're compounding it for 20 years.
I
That's
see.
quite a very huge money, actually losing out.
I see.
You may think that today you're benefiting the 10%. However, you're actually not, you're losing out. That's the opportunity cost. But besides, would it sustain you in the COVID time? That small money you're getting today? Ideally, what we are saying, that you want to address a shortcoming now, but it's not permanent, it's temporary. But the other shortcoming is that we receive 10% of contributions from our employers. I'm very sure no employer would love to see a distortion in that flow, because the intention here is to support you as an employer to live decently in retirement, not to live happily now because they are giving you a wage or a salary. The anticipation that when you are not working with us, we want to see Martin in his retirement time enjoying his retirement because we saved for him. It's a payback to him for having worked for us for so many years.
Even so, the employers themselves,
Yes, they are in support of that. For sure,
yeah.
for sure, yes. Because the issue we are going into, we are going to distort the structure. And the next phase, we are going to see employers coming up in arms and saying, guys, we don't see any good motive of this. Let's change all the structure. There's no need of even contributing 10%. Remember, it's a cost to the employer. So it's a cost for the good intention. But now you're making it as a cost for the bad intention.
I see. And we also see actual investment of 421 billion shillings.
Yes.
As of September. Where's this money coming from?
Yes, these are now the income that were made. We are looking at the period of September 19 and September 2020. Ideally, this income is largely coming from the government securities.
I see.
That's the flow. It is really a very attractive bit.
And at around 15.8 trillion shillings in asset value, all this money is being kept in assets and people are looking for cash. Monetary relief, Mr. Nsubuga. Should be sharing some of this money.
Yes.
15.8 trillion Uganda shillings in asset value.
That is correct. And
Yes.
first of all, we thank the employers, our employers.
Yes.
And we thank the workers, we thank the people who are saving. There's a growth in terms of responsiveness. People are beginning to appreciate that, yes, you need to save for retirement. But this money cannot be accessed. It's not a saving account where you go to the bank and draw, ATM or otherwise. No. This money is, the intention is different. Save for retirement, save it for long term. The intention is, once I retire, I'll get... However, we've also seen people who are still active. They reach the retirement age of 55. They're supposed to be accessing their money in NSSF. And they have opted to keep it there. It's a good intention because they know very well that I don't need the money now because I have another cash flow. This money is supposed to help us in retirement, not while working. If you distort that structure, it means you are creating another situation. Actually, we just need to change our thinking. Can we begin to think of having additional savings for such eventualities?
I see.
Can we create emergency funds? I think our grandfather or our parents had some kind of thing. They would have an animal kept for emergency of some sort, or a certain plantation of some sort for school fees of that kind. I think it's some culture you need to adopt. Can we create some special funds? The retirement benefit schemes that we regulate are ready to have a unique contribution of that kind. As long as there's a separation, because we emphasize Savings for retirement have to be separate or different from savings for any other eventualities because the characteristics are different. Saving for retirement, like I've said, is long term. Saving for emergencies is short term, temporarily. So have another platform, encourage your members to save for such eventualities. They can benefit from the handsome returns that are around in this market because with the structures put up, very prudent fund managers who know where to invest for a good return, which asset classes to pick and to choose. So on that side, there's a very strong foundation for prudence on investment. What we need to do as members or as workers to enhance our savings culture. Can we save more? Can we save more? Can we save more? That's the message we need to send.
And of course, someone did say NSSF money is like a guard dog. It is for a specific purpose. It does not provide milk when you need some. NSSF money is for post-employment, not a health insurance policy.
Correct.
Is that a problem there? Many savers thinking this should have been a health insurance policy.
No. That's not the intention. That was not the intention. From the beginning, if you
It was a
separate,
heated debate.
I know it was, and
Our money is there. We are sick. Can we use some of that money?
I really faced
It was like a health insurance policy.
I faced
Yes.
challenges with that. The good thing, irrespective of that, and I will appreciate the population, they've appreciated. Because when you compare the debate and the pressures at that time and now, when you compare the arguments then and now, I think people have appreciated that. Actually, this money is not an emergency fund. Is not for this particular purpose. This money has a different intention altogether. It's for retirement. And actually people are beginning to think through, we need to save more. We've seen some enhancement in some schemes. Those who are saving 5% have added more for retirement, which is a good message. And those who are also thinking of saving more for any other eventualities, they've opened special funds. They may not be in the schemes you regulate, but when you even discuss with commercial banks, they tell you actually people are beginning to save for different purposes for emergencies, which is a very good attribute.
The biggest contention from many of the people was that, what if I get killed by COVID-19 and I don't hit 55? Shouldn't I be getting some of this money to help me alleviate some of the problems being brought on by the COVID-19 pandemic? That was the major reasoning of many people.
I've heard that argument, but you have dependents. You are not alone in this world. You have people to look after.
Yes.
When you are living, you are able to sustain them. When you are away, something has to fill that gap. Where is the source? And this source is basically for that. That's why our benefits, we say they are for savers and for beneficiaries. You leave behind beneficiaries who benefit. What you need to do is to clearly disclose these beneficiaries. Avoid the confusion at the time when God has called you. Then you leave the confusion behind. Who are the beneficiaries? Please streamline that. It's for your good.
We'd like to know, Mr. Martin Subuga, what are some of the reforms needed in Uganda's pension and savings sector?
We think at Hubra that the first reform that we need to think through is, we think this lump sum payment is not good.
When you hit 55?
When you hit 55, then pay you the lump sum is not good.
And according to your investigation,
there is a lot of research.
In 3 years?
In 3 years, almost 85 or 90% of the people waste the money in 3 years.
Indeed.
Remember, life expectancy to date in retirement is over 17 years. Life expectancy in retirement over 17 years on average. Well,
so you hit 55 and then you get 17 more years.
Exactly. So forget about the COVID distortion and any other factor. But on average, at least the recent household survey showed that people live longer in retirement. So, and people who have attended to their health, people who are responsiveness to taking care of. If you see the corporate world today, they attempt to be very healthy. Their responsiveness, they do exercises, etc. They are going to live longer in retirement for sure. So, why do you want to? For us, we think that we need to have a structure that you have a cash flow of some sort, not lump sum. So we are thinking through of things like income withdrawal of some sort, of spread payments
like
of some
before
sort.
you hit 55.
No, when you get 55, instead of giving you
lump sum,
lump
we
sum,
give it
we
in
can give you a
installments.
third
All right.
of that. but the 2/3 can be spread out in different forms, either annuities. I'm not yet to promote the insurance sector of some sort, but there are other vehicles that people can go into. The income withdrawal, etc. There's so many. But the idea here is that these lump sum payments, yes, they are good, but world over, it has been established it's a waste.
But according to the research I've done, the people who misuse the money, they also have their reasons. They claim that by the time they hit retirement and get this money, they've accrued so many problems in that when they get the money, all that money goes to solving those small problems. They've been accruing over the years. So their major contention was, and it was more like a resolution, can we get access to this money maybe at 45? 10 years before I access the money, I invest it. So by the age of 55, I'm not in panic mode, which is happening.
Of course, two things. It goes back to the other attitude and culture. Thinking that all your problems will be resolved by this having is the wrong attitude.
Right.
You need to have other vehicles to address such issues. But besides, there is effort when in the WUBRA Act. There are two provisions that allow you to access these monies. Things like for a mortgage and for ill health. Ill health, we know it is something that needs to be addressed quickly. However, you also need to think through, many people retire without homes. So what we are coming up with as WUBRA is a regulation. It's only unfortunate that this regulation has taken long. But what we want to see is that people can use these funds as a collateral, as a security to access mortgage. So we believe that commercial banks can leverage on these assets or this liquidity in terms of providing modest rates because there's already a collateral which can reduce on the cost. So people can be able to get mortgages at lower rates. That's something we are looking at.
Right.
However, even in the new amendments to the NSSF Act, there is an attempt to allow some mid-term access, but it has to be characterized by a few things. You must have saved for a long time. I think there's a minimum period. And you must be you must be a mature person.
Indeed.
Mature here, they've defined the age. I think at 40 years of something or 45 years, yes, you can access 10% or some sort. But again, it goes back. What can 10% do? Because the biggest chunk is still remaining there. We need to change our saving culture. We need to think through how do we practice more precautionary measures in terms of putting aside some little money for other purposes and leave this money for that purpose. You asked me about reforms.
Yes.
I've talked about one reform. There's one thing that is not so much common in this market, which we are planning to think through over it, is saving for health in retirement.
I see.
Remember? When you're in retirement, it's very difficult to get a health cover. I don't think there's an insurance company that can give you a health retirement cover. If it is there, well and good. However, we would wish to see products in this market where a person can start saving now for his health in retirement. It will be very helpful.
Indeed. That'll be great. And Mr. Nsubuga, we also do know that 70% of the savers' money is invested externally. Isn't it a risk given the onset of the COVID-19 pandemic that is causing economic meltdown in many countries?
No, that's not right. Almost 80% of the portfolio is in this market, is in government securities. Government securities account for 75%. The equities which follow is around 15%. But of that equity, like I said, 51% is in financial
So no need for panicking.
sector, financial banks in this market. The one that is external is in equities in Kenya, and I've already said we do a prudence. Safaricom is doing very well.
I see.
Other equities, the equities market in Kenya is also picking up very well. So there wouldn't be any fear that the funds are at risk. They're actually well invested.
And we'd like to know what is the outlook of the pension sector in the coming year 2021, given the onset of the COVID-19 challenges?
Notwithstanding the COVID, the outlook we see is good. We anticipate good returns, again 10 plus, because government securities are still 10 plus, much more than that. Number two, We see a recovery in the equities market, particularly in the Kenyan market, which has a huge concentration. Number three, we also think that dividends will be declared for the financial sectors here. And again, the largest, not the largest, but the strong equities in this market, which is Umeme, will also declare dividends in there. So by and large, yes. And finally, of course, we see strong governance in this market. We, irrespective of COVID, we are continuing to enhance our capabilities to supervise the sector, to oversee the sector. So we are in the know of what is happening. We are now, if I to use nosing everything, and we are controlling. So we think all is well, and we can anticipate.
Mr. Nsubuga, before I let you go, we do have people in the informal sector who are saying that even employers with less than 5 people should be allowed to, let their employees serve with the NSSF. Yes. Is this feasible?
Yes, it is feasible, and that one is being addressed, but that is more on formal still.
All right.
We are doing more work. That's one reform part which I've not talked about, on expanding coverage.
It was really crucial.
In terms of reaching out to the informal sector. And we are coming up with a platform which we are packaging in terms of how we can encroach or get more people from the informal sector. Leveraging on their consumer behavior, we know there's a characteristic of people behaving, but we know that people use the current IT platforms that we have. People use mobile monies. We know there are around 25 million users or lines in this country. If you discount that by, say, everybody has 2 lines, so we think that probably 10 million people. When you compare it with the registered members in this sector, they are around less than 2.5. So there's more work for us, but there are already a platform that we can leverage on. We think we can take advantage of that.
Thank you very much, Mr. Martin Nsubuga, for having made the time to speak to NTV Uganda.
Thank you.
All right. Mr. Martin Nsubuga is the Chief Executive Officer for the Uganda Retirement Benefits and Regulatory Authority. My name is Rome Busik. You're still watching Morning at NTV. You're going to take a breather and return with another contentious conversation. I'll be talking to Shamim Malende from the National Unity Platform Party.